Hey everybody, this is Tim Whittemore with the Whittemore Group with eXp Realty. Of course, you're local experts and enthusiastic professionals. Today we're going to talk about different loan products and what you can use for a home and how to leverage your home equity and those sort of things. Just going to give you a brief overview of the different loan products that you've probably heard about before and give you a little insight on those. So first things first, the most traditional one that we have is a conventional loan. And most conventional loans that we're going to see out there are fixed rate loans, meaning that throughout the term of the loan, it's always going to be a fixed rate. Now, we typically have 30-year, 20-year, and 15-year are the most common. Now, obviously, the lower that the monthly or yearly term is, that the higher that the price is going to be because you're paying it off in a much more expedient manner. Now, the interest rates on those will vary depending upon which bank and which sort of strategy that you're using. Now, when it comes to conventional type products, you'll also incur this other fee called a PMI, or primary mortgage insurance. What that essentially is that you're paying money to the bank to secure them to say that, hey, I'm seriously going to pay this off. It's essentially a fee until 20% of the principal is paid off. During that time, then you can give your bank a call and then they should adjust it to get rid of your PMI. So you're only paying principal and interest, and of course the other fees that are associated with the mortgage, which are your taxes and your insurance. So those are your conventional. Now you also have adjustable rate or ARM mortgages, ARM, adjustable rate mortgage, right? And as you probably guessed, the interest rate adjusts. Now, the interest rate is usually based off of some index that they're going to use. And now they sometimes use something through the stock market, something through the banks. It really is dependent upon what they're going to use, but it will adjust based on the market. You have variable rates, you have hybrids between different two, you have option arms. Really, if you want to get some really good details on that, I would talk to a bank in order to see exactly what they use in order to get that. Now, one thing that you've probably heard about before are balloon mortgages. Now, those are usually short rate, usually sometimes just interest, usually a 10-year term where you pay low payments, but at the maturity of this loan, you owe a big sum, which it balloons up, as the name would suggest, right there. You also have interest-only mortgages where it's exactly what it sounds like, where you pay just the interest on it, and then at some point when it matures out, then you'll have to pay the higher rates over time. Now, we haven't seen a whole lot of those. Those were pretty popular before the housing bubble. Now, we also have reverse mortgages as well. What that essentially is, it's more just for seniors. And if they have equity in their home, what they can do is that they'll give a lump sum of that back to them, which could be in monthly payments. It could be as revolving credit, whatever it is. And providing that they stay in the home until death, they should be fine. The only problem is if you do move out prior to that, then all that money that you had requested is going to be due at that time. And normally they'll take it out of the funds that you were saving for retirement anyway to incurred health costs until death. So those you are kind of tricky. Make sure that you really look into those before you get into that. All right. Now, the other ones that they have are government-backed loans. What I'm talking about are FHA, USDA, VA, those sort of things. So let's kind of talk about a few of those. So your FHA loans are your Federal Housing Administration loans. Now, these are loans in order to help people actually get into a home that normally couldn't afford it. Now, your down payment typically for an FHA loan is going to be about 3.5% of whatever the purchase price is. Now, as long as you can do that, then you'll be able to go ahead and get into a home and have a lower credit score in order to actually get into and actually be a homeowner. Now, some things that you could incur over time that I would be really concerned about is this thing called MIP, which is mortgage insurance premium. Now, it used to be like a conventional where when 20% of your principal was paid off, that went away. That has changed. It has changed. So now that just stays indefinitely with the loan until you can either refinance or find another way to pay that off. So that's just an extra payment. Now, this, however, helps people with bad credit to actually be in and at least start the process of gaining equity over time. Now, your USDA loans usually have a very low or minimal, or like 0%. I've seen for USDA loans, it's more for a agricultural development area where they want people to move into. So if the area that you're looking to purchase a house qualifies for that, that might be something that you can look into as well. Now, VA loans, if you are a veteran of the United States Armed Forces and you are at least in there for at least 6 months to a year, I believe, I have to double check that one, you will qualify for a VA loan. Now, the VA loan is a great product where you don't have to put any money down and you'll be able to purchase a house as a veteran. The only thing about this is what they call a VA funding fee. A VA funding fee currently is, if you're a first-time home buyer for a VA funding fee, it's usually 2.15% of whatever your purchase price is that's tacked on top of your loan amount that you're going to finance over the term of the mortgage, which in most cases is 30 years. Now, if it's a subsequent use of your VA, it's usually a 3.3% that's tacked on top. Now, right now, according to the VA guidelines, you can actually go up to 484,900. I hope that's right, worth of your benefit. But just know that you can actually go above that. You're just going to have to put 20% down above that amount, and it could still be a VA loan. Another nice caveat about the VA, we do a lot here, so that's why I know so much about it, is that if you are a disabled veteran and you have at least 10% disability, then you will not have to incur any funding fee at all, which is fantastic. There's some other loan products out there as well that may be associated with the FHA loans, like for first-time home buyers, where they're able to give you a second mortgage on top of that in order to kind of help out. Now, this is something also what they call combined mortgages. So what would happen is you could get two mortgages, one of which was 80% of what the home value is, and then you get another one for the other 20% to avoid the PMI. Now, usually that other 20% mortgage that you're taking out is a much higher interest rate, so it could get pretty expensive. Now, know that PMI is also pretty expensive too, so you'll have to run the numbers for both of those. And of course, I would be remiss if I didn't have to mention this here, but you can also take out a second mortgage on your house. Now, this is kind of like the reverse mortgage, but not really. What this is if you've gained equity in your house over time. What you can do is take out a loan against that, another second mortgage, to take that equity and go use it to either upgrade your house or do it with whatever life throws at you. Now, I would caution you not to take out a second mortgage if you're planning on, or if there's a possibility of you selling your house in the preceding 2-3 years. As long as you've got that much amount of time and the housing market continues to climb like it has been at about 3 to 4% nationwide, then you should be pretty safe. But just know that you could back yourself into a corner where if you did have to sell that house, you're going to have to end up renting until equity evens itself out. All right, well, I hope this was good. This is, again, a quick overview. There are a lot of other mortgage products out there. They're popping up all the time. But if you have any questions about that, I would definitely go reference your mortgage loan originator or your bank. If you want some direction on who to talk to, of course, you can talk to your real estate professionals. You can talk to us. Of course, message us or email us anytime, and we're more than happy to point you in the right direction and give you help on how to finance your first loan. Now, if you're seeing this and you know somebody that could also like or also use this information, make sure to share it with them, send it to them. If you're seeing this on social media, make sure to like and share and help everybody else out to get this information to them. All right, well, we'll see you next time. Take care.